Friday, the 13th of November. Um, I, I've been carping for weeks on the Fed, and not just this business of liftoff, but what its thinking is about the state of the economy, how fast it can grow, and the orthodox idea that if too many people are at work, their wages will rise too fast and then we'll have inflation. And I believe that the world has changed, and that old relationship, which is known as the Phillips curve, is no longer in operation the way that it used to be. And we have strange things underway. Now, a week ago, we got an especially strong job report that was so strong that it looks more and more like an outlier. But it was strong enough that the Fed is likely to raise from zero next month for the first time, liftoff. But the disconnect is between the Fed and the markets. Now, I'm going to wave my arms around. Imagine a graph, and this is a line on the graph. The Fed operates with time zero money. That is, from one day to the next, the overnight cost of money. So rates go up here, time goes out here. Mortgage business, the bond business, is all out 6 years, 10 years, out a ways on the yield curve. Now the yield curve changes shape all the time. This end moves when the Fed moves. The Fed has absolute control over the short-term cost of money down here. When it wants to stimulate the economy, it comes down. When it wants to slow the economy, it goes up. Movement out here is purely a market function. And there are irrational times when they move in opposite directions. One of the most profound warnings that the market can send to the Fed, and is the bond market, is the Fed starts to do this, and long-term rates either don't move or come down. All the way back to World War II. Every time that happens, and every time the two rates cross over, which is known as an inversion, short-term rates higher than long-term, we have a recession. Now, what's been happening in this last week ago, strong economic data, big jobs number, Fed's coming in December, long-term rates shot up, but they couldn't even make it up as high as they were last summer. It stopped out at about 230. The highs last summer were 240, over and over and over, 10-year. In mortgage terms, both are just above 4, but the 10 years definitive. Last couple of days, this thing starts to come down as the probability of the Fed going up rises. Early in a Fed cycle, coming from zero to some unknown higher point, these guys ought to rise together, and the whole curve ought to go up in one piece, and it's not. We can explain the phenomenon maybe by yield-hungry investors overseas gobbling up U.S. bonds, holding long-term rates down. Maybe so. It's probably part of it. But another explanation is that these guys think that if the Fed pushes up here for very long, we're going to have a recession. I'm with those guys. In the copy nearby is a description of the background, some of the theoretical thinking, and underneath the copy are a couple of charts. And they're both the same thing in different formats. And to print two charts saying the same thing is one way of yelling at you. The two charts show the Fed's future intentions. That is, its statement of at what slope it intends to push up down here. And also contains a second line, which is the market's expectation of that same movement. And the market is saying that it will happen at less than half the pace that the Fed says. And I'm here to testify that in the bond market already, these guys are betting that if the Fed begins to come up off zero, it won't have far to go. And the odds of overdoing it and having to come back to zero will rise with each step. Now, the good news is, I don't think mortgage rates are going to go up a lot. I don't think they're going to go up enough to hurt housing. Don't worry about it. There'll be all kinds of Fed talk in the air. The stock market may suffer from time to time, but as it has this week. But our business, housing, mortgages, I think we're going to be okay through the winter, maybe into the spring, and who knows, maybe for quite some time. Have a good weekend.